Hello, everyone. My name is Manny Frangidakis, and I am the co-founder and principal of 12 Points. Thank you so much for joining us on today's webinar, Blockchain 101 with Accolade Partners. Joining me today is Aram Verdiyan, one of the partners at Accolade. Prior to giving Aram the mic, I'll give him a brief introduction. So previously, Aram worked on the investment team at Andreessen Horowitz. Before that, Aram worked in BD, sales, and marketing at Aviatrix, a cloud-native enterprise software company. Aram worked at Accolade from 2012 to 2015 as a senior investment associate and at Deloitte Consulting LLP. He holds an MBA from the Stanford Graduate School of Business and a BS from George Washington University. Aram, thank you for joining us today. It's great to have you.
Thank you so much for having me on.
So we'll jump right in. I don't know if you want to give a quick background, a little bit more on Accolade, or if we want to just jump in onto kind of what are the basic principles of blockchain and cryptocurrencies.
Yeah, I mean, very quick 30-second background on the firm. So I've been in the firm about 13 years now. We're a small partnership based in Washington, D.C., $6 billion under management. Our clients are firms like yourselves, endowments, foundations, family offices, pension funds, primarily in the US. We allocate to three areas in the private markets: venture capital, private equity like growth equity, and blockchain. Blockchain is about 1.2 billion of the 6 billion in committed capital we have, and I believe we're the largest allocator globally to blockchain funds. So we run fund of funds products in blockchain and been doing it for 5+ years now. And very happy to have been partnered with folks like you and a number of other LPs to give them exposure to blockchain technology through our fund of funds products.
That's great. Congratulations on the success the firm has achieved so far. So going into the venture capital side and talking about growth equity, how does blockchain differ from those two kind of asset classes?
So, it's interesting. You can look at how technology has evolved over time, and there are a number of offsprings of tech. There was AR, VR, there is computational biology, there is healthcare tech, and then blockchain as well. There are moments in time where the technology, the sub-technology gets large enough where you think, does this require a dedicated effort within a venture capital firm? And so what do I mean by that? So if you look at healthcare today as an asset class within private markets, it's very hard for a tech company, a tech fund, to do healthcare unless you have a dedicated team, dedicated product around it, because the sourcing, diligence, post-investment work is very different than if you invested in a traditional SaaS company on the enterprise software side. So if you look at blockchain technology, and by the way, on the contrary to that, you look at a technology like virtual reality or augmented reality. We didn't necessarily think there was a large enough market, enough developer activity that warranted for there to be dedicated funds in the space. A tech fund couldn't do that within their own general mandate. So blockchain as a technology started showing up in our funds and in our portfolio back in 2014, 15, 16. A number of our managers were doing one-off investments in the space. And it became very clear by 2018 that this space is growing incredibly fast. The tell signs were the talent that was coming to the space, whether you look at universities like Stanford, MIT, Berkeley, whether you look at communities and incubators like the Andreessen Crypto School, large tech companies, talent was coming to the blockchain space. Developer activity continued to increase. Secondly, you started to see managers hire dedicated folks to do blockchain investing, because every point of the work you needed to do in blockchain was very different from traditional tech investing. Sourcing was different. You needed a different background to do blockchain investing. A lot of the times you need backgrounds in distributed systems and cryptography. That's very different from a traditional tech background. Investing in a decentralized network, and we'll talk about that, a blockchain company or a decentralized network, sitting on a board of that company, adding value to that company, thinking about liquidity for that company, diligencing that company is completely different from traditional venture. And so what you saw in 2017, 18 is big firms, and all the big firms you would know on Sand Hill, et cetera, they would hire one or two people and say, you guys are the blockchain people. So 5%, 10% of our portfolio is going to be in blockchain. And I think that's a really hard model because every Monday morning meeting, this one or two people are educating the rest of the partnership on what blockchain is. And so what happened over time is those folks left and they started their own dedicated venture blockchain funds. So you saw talent come into the space, you saw the opportunity set grow, and then you saw managers recognize that opportunity set and raise dedicated funds. Fast forward 5 years, there's 450 dedicated venture blockchain funds. And so we as a firm looked at them and said, okay, well, this is no longer a small asset class where you can have one fund investment. You need many fund investments. You need a diversified portfolio, and you need a dedicated effort within Accolade to prosecute the space if you want to do it right. In a similar way to healthcare, as I said earlier, if you are a tech fund today and 10% of your portfolio is in biotech, well, good luck competing with the dedicated biotech funds that have billions under management, that have been doing it for 20 plus years. They have the right research staff, technical expertise, and again, where you have to look at the workflow is very different. Sourcing, diligencing, adding value, involvement post-investment, those are completely different for blockchain as they are for healthcare relative to traditional tech. So that's how we thought about the space. And in 2018, 2019, we saw the separation of it's part of venture to it's a whole different part of the venture capital stack and requires a dedicated effort.
Yeah, that makes total sense, Aram. So since you brought that up, and let's like pull it a step back. So you mentioned the differences. So what do you, in your opinion, what are the core principles of blockchain technology and how it works for those that are unfamiliar?
Yeah, so let's define it, and I'll please jump in and stop me at any point if something is not making sense. Blockchain technology as a concept has been around for many decades. I know this may sound contrarian, but it's not. Like you go back to the 60s, 70s, 80s, a decentralized record-keeping software system has been around for a long time. It keeps the records shared among participants, it's verified by everyone, the data is encrypted, unchangeable. What I just said is nothing novel. It's been around for, again, many decades. And you can go to Deloitte and Ernst & Young and say, well, I want to do something on a decentralized ledger. Can you help me implement it? You've been able to do that for years and years. What's different about the blockchain technology and innovation we're seeing is that applications and all the infrastructure companies that are being built on top of this open source blockchain technology. And I think the key concept is for the first time in the internet, in the tech era, you're able to program value and ownership into the actual blockchain. I think this is really important. So value and ownership, hold that thought for a second. You can actually program it into the blockchain. What does that mean? So go back to when the internet was first started. Remember the AOL days, et cetera. And so in the 90s, before, like internet, you started to have some applications on the internet, like AOL is an example of that. HTTP, that protocol layer, was free. Anyone, it was open, no one controlled it. You can build a successful internet business on top of it. You owned that business. You controlled it because no one could shut you down. It was the open web in the 90s. The problem back then was the products were very limited. All you saw was really something offline was taken to online. There were no social networks. There was no user-generated content. So the products were very limited. But the web was open. Like you can go and build on it. In the second era of the internet, so call it the Web 2, what started happening is large tech companies, Google's, Facebook, Twitter, etc., started building on top of the internet, and you started to see robust social networks, consumer marketplaces, products that were actually closed in nature. What does that mean that they're closed? Well, they attracted customers, third-party providers, applications. They grew over time. They owned all the data on the platform. And if it was not beneficial to them on that platform, they would kick you off the platform. So take the example of Zynga, which was a gaming company on Facebook. When Zynga got too large, Facebook kicked it off. So the platforms on which you started building actually became closed. If you are Epic Games and you are doing billions in run rate revenues, you're controlled by the Apple Store, which is extracting 30% from every transaction that happens on Epic Game. 30% is more than what the actual developers make when they're the ones developing the games. Amazon can prioritize its own products in search over third parties. So you no longer had an internet that was open. You had an internet that was, you had large platforms, they controlled the data, and they controlled building on top of their platforms. So there was no open composability to say, I'm a developer, I can build something freely on the internet. Like today, if you look at data and advertising, it's really controlled by 5 to 6 large companies on the consumer side. So what again, go back to this concept I said, value and ownership being programmed on the blockchain. That's really what started happening, the movement that started happening in 2018-19 with, and you started to see innovation in blockchain. Open source blockchain has been around for a long time, but developers started building applications on an open source blockchain. They were consumer centric. The blockchain, the decentralized network, looks very similar to a regular company, but it allows all the participants in that company to participate in the upside and the ownership of that company. It's no longer that Facebook management team and the investors own all the equity and the value and the data, etc. You as a user get to participate as an owner in that business. So a lot of the time we'll talk about tokens and how they're important, but a token-based business model, not the meme coin tokens, but actual businesses that have tokens, are an incredibly novel business model because you can actually allow users to be owners. Tokens incentivize activity early on. Instead of me spending $1 million on advertising on Facebook and Google, I can bootstrap my network through tokens and create consumer activity early on. And then as those tokens grow in value because the platform grows, it rewards the founders, contributors, and everyone who is participating in the network. So you can create businesses today where the value is not owned by 4 people on the management team and the VCs on the cap table. You can create businesses that are open and the value is given to the community, as well as to the management team that's building. But if you look at decentralized networks, more than 50% of that business is owned by the non-founders, non-investors, more than 50%. This goes back to being composable and open. We're going to go through a lot of examples. I'll give you one quick one. So Twitter is a great example of that. X now. It's a closed system. You really can't build an application on top of Twitter. It's just not possible as a developer.
Right.
We have a company in our portfolio that was started by an individual who was an early employee at Coinbase called Farcaster. Farcaster is very early, but it has over 100,000 daily active users now. And Farcaster is the decentralized version of Twitter, where you can go today and build an application within Twitter, within Farcaster, where it looks like Twitter. And it's open. No one can shut down that application. You can get to hundreds of millions of users and revenues on Farcaster, and Farcaster will never be able to shut you down, the way Zynga got shut down on Facebook. So that's where the opportunity sets. So when you look at financial services, you look at consumer marketplaces, you look at every traditional industry that has been disintermediated by tech, there is now a level of disintermediation that can happen with blockchain, because every large internet product could actually be created through a decentralized business model. So I'll pause there. We can go in depth about a number of things, but hopefully this sort of sets the stage on where we saw the opportunity set early on, and that's where a lot of the developers and the talent went to build on.
Yeah, that's a great description of DeFi or decentralized finance. So I'm assuming you agree that some of these monopolies should be worried?
They're not worried today. I mean, they have incredible network effects. So let me define what a network effect is. A network effect business is a business where as you add a new user to the platform, it's beneficial to everyone on the platform. The level of data capture, revenues, and scale these companies have, I think they're not looking at blockchain technology today and saying, well, in the next 2-3 years, we're going to get fully disrupted. If I were Twitter and I'm looking at Farcaster, and I think Elon Musk knows this, like he has actually looked at blockchain technology and potentially decentralizing some of it. The issue, Manny, is I don't know what can be done by the big incumbents. And here's why I say that. Google today is a public company. It has public stock, it's owned by investors, it's owned by the management team, it's owned by employees. In order for them to decentralize their business, they would have to scrap the business model, they would have to scrap their cap table and say, we're going to institute a way to give value away to the actual users, away from the existing cap table, from the existing stakeholders. It's just not a possible path to take.
Right, kind of goes against corporate governance.
Exactly. Yeah, by the way, we should talk about that as well, because
please,
community building and governance is also a key point of blockchain. 3 people in a conference room cannot decide for a decentralized network what direction the company should take. The community is voting on that. 51% of those businesses is typically owned outside of the management team and the investors. So, and I can give you many examples of tech companies where they made a change and the users and the suppliers and every constituent on that platform was really upset about that decision that was made. Well, it's very hard to do that in a decentralized network because you actually have to get the buy-in of the community to do so. And so,
So,
by the way, this goes back to the earlier point I made. When you're an investor in a blockchain company,
mhm.
you are part of a decentralized community. You're not sitting on a board, you own 20%, and there's a vote every 3 months. Like that post-investment involvement and management is very different, which goes back to you need a dedicated effort. And the investors in blockchain are very different from traditional venture investors.
Fair to say that this would allow, people down the street, your next door neighbor, to get into venture opportunities that previously they didn't have access to?
So let's talk about that. So the way a decentralized blockchain company typically transforms over time is, let's just take you and I want to start a blockchain company, and we need to raise a couple of $1 million to hire developers to build a product and launch and try to get customers to see if we have product market fit. You typically still do that in the private markets. You go and you would raise an equity round of some sort that says, if I'm successful and I can launch my token to start attracting customers, the investor who invested in the equity will have token warrants.
Mhm.
No investor typically owns more than 10% of that network. So unlike a traditional seed manager that can own, or Series A manager can own 20, 25% of business, these rounds are small, they're more capital efficient, and no investor typically owns more than 10%. A lot of the times less than 8%. So you and I will go and raise 1 to 2 million in the private markets. We'll try to prove out the product. We'll get a few VCs to do so early on. And then we may also end up raising one more round before we want to launch publicly. When we launch publicly, that's when, and to give you a sense, the company is usually a couple of years old. That's the public market event of that company. In the traditional venture space, you go public at year 7 through 10, sometimes even later if you look at today's market. Here in blockchain, you could go public earlier. You can go public in year 3 and year 4. The company's still early, but when you do go public, you make the tokens available to the general population and the users who are using the business. And again, tokens could have a bad connotation because you can look at a dog coin and say that has no value. I would agree with that argument. It doesn't. It's a meme coin. But tokens generally can have a number of, the way we think about tokens in our portfolios and our managers do is, tokens have the following functions. They can be a way to acquire customers early on instead of spending money on ads. You incentivize folks to use your product and become owners and earn tokens that have monetary value, and that value goes up as the business grows. That's number one. Secondly, tokens are used for governance. If you own X percentage of tokens, you will actually have a vote as part of the community for the direction of the company. Third, you could actually own a stream of the revenues or the profits of the business by being a token holder. So those are sort of the 3 ways a token has value. If you ask me what value does a dog token have, I can't give you the answer to that because I don't know if there is any value. But so you and I in year 3 could launch our token and say 51+% of the tokens are going to go to community and the users. 49% will stay with us, the management team, and the investors. We'll program the network in a way where the tokens have value as the business grows, and we're off to the races. The beautiful thing, Manny, is the company usually does not need to raise any more capital. So it's an incredibly capital efficient business because instead of raising tens of millions of dollars for ads and marketing and sales, you can get to escape velocity and real traction with no money spent. I'll give you one specific example. Uniswap is one of our portfolio companies. I think everyone is familiar with Coinbase as a business. It's a traditional exchange. It operates like any traditional exchange. It has book order format where sells are matched against buys at the best available price. They take a cut. Like that's the transaction model that Coinbase has. Uniswap is the decentralized version of that. There is no centralized market maker at Uniswap. Individuals can come and create liquidity on the platform and themselves become market makers. For doing so, they earn Uniswap tokens. So you don't have a centralized party. Everyone who is contributing to the liquidity of the pool gets paid in Uniswap tokens. Uniswap tokens have monetary value, and now Uniswap token holders are getting dividends from the revenues of that company. And then here's the statistic that speaks to the capital efficiency of that business. Coinbase has over 1,000 people, has raised hundreds of millions of dollars to get to the scale it is today. Uniswap had 11 people, raised less than 11 million in capital, and got to hundreds of millions in revenues and billions in transaction volume. It's the beauty of actually outsourcing your growth to the community. You have a far stickier and a better business model when your business is aligned with the people who are using it. The business today is not aligned for Facebook and Google. Like, you and I are not aligned with those companies. They own our data, they use it on our behalf. We have no control. We don't get any monetary value from it, but we feel captive to those platforms because our friends and everyone are using it, right? They have a network effects business.
Mm-hmm. So it's extremely capital efficient, way different than traditional models.
Yeah, I mean, there will be blockchain companies that raise more money, but Uniswap, to give you a sense, got to that scale for a fraction of the capital that Coinbase had raised. And you could raise more money than Uniswap ended up raising another round after that because they launched a wallet solution that you can use now. But the core business of the exchange doesn't need more money. They're off to the races, and the run rate, they're doing over 500 million in revenues right now. This business is 5 years old. By the way, it is very hard to find in traditional venture or in any private markets a business where if I tell you 11-person team raised 11 million in capital, 500 million in run rate revenues.
That's amazing.
$0 spent on customer acquisition marketing. That business does not exist.
No,
I'll give you another business whose ETF just got approved. 6-year-old business, small developer team, 2 billion plus in run rate revenues, 90% plus EBITDA margins. That's Ethereum today.
Yep.
So but again, like, very little capital raise. When did Ethereum raise money? They raised like 1 or 2 rounds, the way I described you and I would raise it if we started a company. That's it.
Right.
It's an incredible capital efficient model. And Ethereum is the operating system on which a lot of these applications are built on. So it's like the AWS of blockchain. And it's doing 2 billion in run rate, profitable, highly profitable, because they have no expenses.
Right.
By the way, these numbers I'm throwing out there, 2 billion, 500 million plus, it's all on chain. All the revenues are on chain. Going back to everything is built on an open source blockchain means every transaction is actually seen and recorded on the blockchain. So I can go on a number of websites and on a daily basis see, where is Ethereum earning its revenues from? What are the transaction volume for Uniswap? And what are the revenues on a daily basis that are coming in? I'm not waiting for quarterly reports on the public markets to then assess and get guidance for the next 6 months. I'm looking on a daily basis and seeing how the company is doing on chain.
Yeah, so let me summarize that real quick, or at least take my points out of it. So it sounds like it's probably more secure and there's far more transparency, in particular in a world where it seems like technology companies today, traditional ones, are trying to go the opposite direction.
Yeah, can I talk about the secure point for a second? Because sometimes blockchain gets this headline of, well, blockchain is only used for illicit activity. I love this argument because for folks who understand blockchain, it's the complete opposite. So the takeaway, at least from the last 23 minutes of our conversation, should be that everything on the blockchain is open source and available for everyone to see. Crypto and blockchain is easier to track than anything you would ever do with cash. Every transaction is recorded, it's searchable, it exists on the blockchain database. So if I'm a law enforcement agency, I just got substantially more information than I ever would if there is a case in blockchain, because I know the date, time, amount of the transaction, type of cryptocurrency used. Most importantly, the wallet address that was involved. Every wallet address is on-chain and available. So when folks talk about illicit activity for blockchain, to me, it's, if I'm a criminal, the last technology I want to use is blockchain, because to track it down is incredibly easy. And let's actually look at the data. Illicit activity accounts for less than 1% of all blockchain transactions. Where is most of the illicit activity going? It's cash. 1.6 trillion in cash is laundered every year, according to the UN. It's not through blockchain. If it happened to blockchain, law enforcement agencies would have a very easy time. And again, once that data is recorded on the blockchain, you cannot change it. It can't be removed. It's not a closed system. I'm not Facebook where I can go delete something, change something, and then just tell the customer sorry. It is immutable. So that's the beautiful thing about, like, sure, go do illicit activity on blockchain. You're going into a battle with one hand behind your back.
Wow. Yeah, that's fascinating. So since you brought up some, government agencies and whatnot, and I know the DOJ has come out and has opined on blockchain, where do you see the industry right now presently from a regulation standpoint, and where do you see it going?
Good question. I don't have a clear answer. I will tell you that it's moving all in the right direction. A year ago, you saw this approach the SEC took, there was enforcement actions across the board. No framework in blockchain. Let's just do enforcement actions. It's essentially giving speeding tickets to everyone and saying we're not going to tell you what the speed limit is. That was the MO last year in 22, and I think part of that had to do with FTX, and we can talk about that as well. When you look at what's happened over the past 6 to 12 months, a number of court cases have been won by blockchain companies, Grayscale, Ripple. A number of ETFs have been approved. A number of bills, market structure bills, stablecoin bills, are in the House and the Senate. TBD if any of them pass, but there's been incredible positive movement towards let's establish a framework for what is a security in blockchain and what is not a security. The crux of the debate, where the SEC is now willing to take a position on per se, is something a security or is it not? And again, the definition of a security is they use the Howey test, which says that if there is a capital investment, if there's an expectation of profit, if that expectation of profit is coming from a centralized group of people, then it's a security. Now, take the example of you and I starting the blockchain company. You and I raised $2 million from investors. There's no retail participation or anyone. It's just you and I raising 2 million. Is that a security? You can argue maybe it is, because it's you and I are in the private markets doing that, but we're doing the credit investors with the right disclosures. When you and I launch our token, 51+% owned by the community, we're decentralized. The fate of our network is now in the hands of the community. Then the question becomes, what level of decentralization is needed to assess whether something is security is not or not? If you and I own 80% of the network and it's launched, yeah, sure, it's probably security because you and I literally own 80% of it. So I think there is the debate and lack of clarity comes into what is actual security, what is not. And a number of draft bills were introduced around crypto market structure, which said that you can determine the level of decentralization of a company, which will then tell you what's a security, what's not a security. So you look at something like Bitcoin, you look at something like Ethereum, the CFTC will say those are commodities, they're not securities, they should be regulated by the CFTC. Are there projects out there that have tokens that look like securities? Probably. There are a number of projects out there that are not securities as well. But unfortunately, there has been no framework and clarity into what is a security, what is not. But our hope is there's been a lot of positive movement, and we will see more over the next 12 months. Outside of the US, regulation is far more favorable, I would say, to blockchain technology. So Europe, the UK, Asia, Latin America, they're embracing blockchain technology. They're creating frameworks, both on the stablecoin side for DeFi, what's a security, what's not a security. I mean, the belief we have is, look, this technology is here to stay. Developers continue to come into the space. It's a huge part of the developer mindset. And the US over time will play catch up on the regulatory side. I can't tell you what the timing is for that. I would have hoped we would have had more clarity today. We haven't. With the election season coming, I suspect nothing gets done between now and election season. But in 2025, I do expect there will be significant regulatory movement in a positive direction.
So it could potentially even be a ballot issue.
There's over 50 million crypto holders in the US. I think it definitely will be.
Yep. That makes sense. So regulation will change over time. Potentially developers and whatnot might have to give filings to the SEC. Probably provides more transparency going forward and making the product more secure.
Yeah, let me give you a specific example on that, because just to remember the example I gave about you and I. So Ripple is a company that won a partial victory against the SEC lawsuit. The SEC said Ripple is a security, the token. The SEC was alleging that all their XRP tokens are security. Judge Annalisa Torres of the Southern District of New York, she ruled that while Ripple's sales of tokens to institutional buyers were investment contracts, so essentially that example I gave you and I raising 2 million from investors. So, but the sales of tokens on exchanges to the community and the tokens that are natively distributed via the protocol are not a security. What does it mean natively distributed by the token? So if I am doing a transaction, if I'm using the product as a user and I earn the token, the Southern District of New York deemed that that is not a security. But the first round that you and I did, where we raised money from professional investors, that's security. That's the great delineation, by the way, because we raised an equity round with token warrants down the road if we launch a token. That equity round should follow the same structure that any venture capital round should follow. But the judge clearly said, when you launch a decentralized community and there's programmatic distribution of tokens, it's not a security. So that's where the framework needs to come in to determine what's a security, what's not a security.
Understood. So given the fact that you guys are in the marketplace, how do you guys assess the value of a potential new cryptocurrency or a new blockchain type product?
We are a very, and I can speak for myself and our whole team, we're a very, call it basic fundamental investors. We don't care about hype. We don't care about if something has .crypto or .ai at the end of its name. When we think about a protocol, a company, an application, we look at users, applications being built on top of it, revenues, team, product market fit. That's what we want our managers to do. By the way, we don't invest directly in companies, we invest in managers, but every manager we talk to, we ask them to walk us through what is the diligence they have done on that company to arrive at the conclusion they have. And it is never finger in the air of like, oh, this can be $100 billion company, or this is a coin with a dog on it and it's going to do great. Like, it is fundamental analysis based on product market fit, team, market size, actual revenues and traction, competitive dynamics, etc. Essentially, all the work you would do in a traditional private equity or venture capital space. I think what's benefited us a lot, Annie, is we didn't start our careers in crypto. There are a lot of blockchain investors out there where their first job was blockchain investing. And unfortunately, I don't necessarily know if that's a good thing, because you haven't had traditional private equity fundamental frameworks that you can apply here. And I'm not saying it's a one-to-one mapping of what you did in private equity should apply in blockchain, because I think the markets are bigger. I mentioned how companies can scale faster in a more capital efficient way, but some of the frameworks are the same. At the end of the day, if a company goes public, you're going to have to run some sort of a DCF, fundamental analysis, to arrive at its valuation. And so I do think those frameworks, business building frameworks, financial frameworks, are really important. So we would, and this is one thing we press on for our managers and the companies, is like, make sure the valuations make sense relative to the traction and the opportunities that the company has. I can point to a number of companies that are overvalued. I can point to a number of companies that are undervalued. There are a number of companies today in blockchain that are doing hundreds of millions of revenues. They're highly profitable and they're undervalued. And there are also ones that are pre-product market fit that have billions in market cap. There are literally, if you look at the top 10 crypto, like if you go to CoinGecko, CoinDesk, whatever, and look at the top 10 cryptocurrencies by market cap, like 5 of them don't do anything, but they have billions in market cap. There is no developer activity on their GitHub repositories. No products are being built. There's no revenues. I don't even know if the teams are working on them. But the other 5 are killer projects. So that's and the problem is, in the headlines, it's the 5 that don't do anything.
Right.
Which, by the way, is great for us. We don't mind that, because we're heads down working. And by the way, our work is the reason that we've been doing this for a long time with the biggest scale than anyone else. We didn't have exposure to companies like Celsius, Voyager, Babel Finance, FTX. Like, we avoided all of that. If you're a tourist in the space, that's the exposure you might end up getting.
Yeah. So that's a great segue. So number one, if investors were interested, how do they gain exposure to this space, and how do they stay away from potentially, tokens or companies that aren't developing and aren't putting products out there and aren't having cash flows?
I'm going to give a very simplistic answer, and I give this to everyone. Someone who wants to invest 100K in crypto to someone who wants to invest 100 million in crypto. I would only do literally 2 things. So assuming you don't have a dedicated effort in crypto, a team like us, that's actually like day in and day out prosecuting those. Every manager knows the companies, can spin up analysis because they've been in space for a long time. When we do analysis, we can call our whole network of 20 to 30 people in one day and arrive at a conclusion. I am assuming you don't have that if you're asking that question. If you don't have that, I would do 2 things. I would buy Bitcoin and ETH, and I would, if you want further exposure outside of that, I would go and invest in some sort of a vehicle that gives you diversified tier 1 exposure to the early stage projects in blockchain. By the way, it's not very dissimilar. If I'm running an endowment and someone said, how do I invest in venture? I would say, well, go buy the FANGs and then go invest in venture capital funds. Now, if you can't invest in venture capital funds directly, do it through a fund of funds. That's essentially where and why Bitcoin and ETH? Bitcoin Bitcoin is not going anywhere. I think it is the largest network effects business. The numbers, I don't know how you think about numbers for Bitcoin, because if I apply the same fundamentals I applied in terms of revenues, developers, applications being built on top of it, it's not necessarily there. But I will tell you, Bitcoin serves the purpose of store of value, medium of exchange narrative. It's decentralized, it's peer-to-peer network, no central entity can control it. It's permissionless, which means anyone can own it. It's transparent, which means there is only 21 million Bitcoin available. That construct is far more superior to something like gold. And you've started to see some countries like El Salvador, Central African Republic adopt it as a legal tender. As ETFs happen, people will hold it in their treasury. As more countries adopt it as part of the reserve currency, it is here to stay. If you want blockchain exposure, hold some Bitcoin. Secondly is Ethereum. Ethereum is the operating system of blockchain. It is essentially where it's a smart contract solution on which applications are being built on. So if blockchain is going to be successful as an industry, the infrastructure layer that taxes everyone, that's doing 2 billion in run rate, highly profitable in 6 years, is Ethereum. I would own that too. On top of that, we don't have to get into this, but Ethereum is deflationary. This is in a very simplistic way, Ethereum's revenues on a daily basis are used to buy back its own token and burn it, which means it leaves the circulation. Your circulating supply goes down every day. And so as Ethereum does better, token supply goes down, which means token price goes up. Literally, it's a reflexive system where the revenues are used to buybacks. Because when people ask, like, what happens to the revenues? Well, literally on a daily basis, the supply goes down. As long as Ethereum today generates a little over 3 million in revenues, which is run rate, as I mentioned, 360 million. So it's about $1 billion. So it's going to be significantly deflationary. And if you expect ETF flows to come into Ethereum, that's going to have more upward pressure on price. So I would hold Bitcoin and ETH. How would you hold it? I would just do it to something simple like a custodian you can trust, like a Coinbase. And then the other question is, well, do I just invest everything at once, or do I come in over time? DCA it. Like, you should not be in the business of trying to time the market in blockchain. Like, pick a slug you want to invest, do it over a period of time. Next thing you can do, if you want to go further down on the risk spectrum and say, okay, well, blockchain is a lot more than Bitcoin and ETH. We can talk about all the different use cases and applications, everything from what I mentioned, Farcaster, the next Facebook on blockchain, to AI applications of blockchain. How do you get exposure to that? You do it through blockchain venture funds. And if you don't have a dedicated team, I would do it through a fund of funds, because it is too early and the space is too nascent to play expert in the space unless you have a dedicated team doing it. This is exactly why, by the way, not going to name names, but you look at the cap table of FTX, it's not crypto firms, it's generalist firms. It's exactly why. You need to be dedicated to the space 100% of your time.
Interesting. Thank you for that, Aram. So you mentioned it being very early stage. I mean, it sounds like if we were going to draw a line to a baseball game, is this inning one or?
So here's where we are in blockchain. I can point to dozens of companies that are doing hundreds of millions in revenues: Uniswap, Maker, Lido, Ethereum, Arbitrum, etc. A lot of these are either in financial services or infrastructure. The area so that's probably inning two. My guess is a lot more to go. Inning one is consumer applications. And so that's the Web3 vision. There are a number of companies that have anywhere from 100,000 to million plus users. So one of our former employees at Accolade, actually, he started a business called Layer 3. It's an incredible business, 20 plus million run rate, 5 million plus in users in 3 years, blockchain business. So there aren't many like that today. I think most are sub 1 to 5 million in daily active users, but growing because the use cases are early. The institutional asset class really got started in 2018. So Ethereum, on which applications are built on, launched like 6 years ago. So it's like saying, well, the operating system launched 6 years ago. The App Store launched 6 years ago. The applications are now being built on top of it. So I think we're early days. There are a number of use cases that are large: stable coins, decentralized finance, real world assets. we're seeing a lot at the intersection of AI and blockchain. I think a number of those projects will be huge, and there's going to be a lot of carnage in that space as well. By the way, I say the same thing about traditional AI. Traditional AI right now looks like blockchain in 2021. Valuations are out of control. Everyone is pivoting to AI. The loss ratio is going to be massive there. But there is some interesting things, and we can talk about specific projects at the intersection of AI and blockchain. And then you have consumer companies like Farcaster, the decentralized version of Twitter, like Demo, which is connecting your card data on the blockchain. Incredible business model that I think solves exactly what we talked about, the issues Web 2 models have. Companies like Helium, which are creating a physical network for you to connect your phone to. And those companies are 100K to a million-ish in users today, but growing fast and inflecting. So inning 1 to 2, not more.
Yeah, that's fascinating. So we're early stage. How do you see it getting more widely adopted? You know, what would it take to get more buy-in, whether it's from institutional investors, more hedge funds, getting more widely adopted across industries?
So here's the interesting thing about I get this question like, why are there no use case in blockchain? Oh,
Yeah.
Let's talk about stable coins. It's probably the biggest use case in blockchain. What is a stable coin? It's a tokenized asset that's pegged to some reference asset. The reference asset can be the US dollar.
Mm-hmm.
And like, why do people need to use stable coins? I can just use the US dollar. Well, stable coins are far more superior as a technology product than USD and than cash. They're borderless. They're easy to accept as payment anywhere in the world on a public blockchain. They settle immediately 24/7, 365, which makes them incredibly available and reliable. They offer users stronger autonomy, privacy, interoperability than other existing payment solutions do. Best part about stablecoins is going back to they are programmable, they're composable. So if I am a developer in blockchain, I can go tap into the Circle API, and immediately I get distribution to an instant access to capital. Meaning, everything is done on a public blockchain. So if I'm using a stable coin, I can do borderless payments in developing countries. I can transact 24/7. It settles immediately. There's no inefficiency in that. And what's the scale of stablecoin? Today, it's on a run rate to surpass every large payment processor, Visa, MasterCard, American Express, etc. So is that a small use case? Absolutely not. It's massive. Circle is going to go public and is going to be a massive company in the space. So other use cases that are growing fast, real world assets.
One quick question,
Yeah.
Ram. So given the fact that we're in an inflationary environment, how can stable coins or crypto being more widely adopted protect consumers and participants in the global economy?
So stable coins move with the dollar. So Circle is 1-to-1 pegged to the US dollar. So it is just a more efficient way for you to move money around and do payments. So inflation per se, interest rates are going to affect the business model, less inflation, because as interest rates go up, obviously your reserves are earning more yield. Like there are many business lines within Circle and stablecoin providers, and one of them is the actual interest you earn on the reserves you have.
Mm-hmm.
I think that's where you'll see volatility as interest rates go up and down, like you would in a traditional bank, by the way. No different there.
Yep. Okay. But if you're in Ethereum per se, it's not like you just mentioned the fact that it's deflationary and that they're using the revenues to buy back tokens.
Yes.
They're not going to go out and create 30% of money supply in 1 year, similar to some governments.
Yeah, I used that line before. Yes. I think this goes back to Ethereum. I think of as technical. You're making the case for Bitcoin, by the way. So the case of Bitcoin is that no centralized entity can control it. There's no way for them to shut it down, censor it, and it's available to everyone.
Mm-hmm.
And to your point, you can't just increase the supply by 30% in 1 year. The supply of Bitcoin is 21 million forever, and it's going to be until 2140 before the last Bitcoin is mined.
Mm-hmm.
And so if I'm in a hyperinflationary environment like in Argentina or Venezuela, using something like Bitcoin is incredible. And now the argument is, well, Bitcoin is too volatile to use for payments. Sure, but there are infrastructure companies sitting on top of Bitcoin using the Lightning Network that make you have a transaction with Bitcoin that's instant, where you don't actually get to really face that volatility. It's not like I'm gonna buy it with Bitcoin and 2 days later it settles and now the price is X. That's not what's happening in Bitcoin.
Mhm.
Do I think Bitcoin is going to move to be a payment network? I don't know. I'm skeptical, but I do think Bitcoin will move to be a safe haven, a store of value, and an asset that protects you from inflation in hyperinflationary countries and environments. Ethereum, arguably, you could do that with as well. I sort of think of Bitcoin as money and Ethereum as like the oil of the economy of blockchain. You need it like it's really the AWS, the operating system. Like everything works because Ethereum has the largest developer community and applications are built on top of it. It's an amazing business model. Ethereum being deflationary as it scales has a reflexivity in its model. Like if you're running a DCF on Ethereum, it's not a straight cash flow model because you have to account for the fact that as it goes up in revenue model, there is reflexivity in that model. So again, like there's many DCF models you can do. There's a website called ultrasoundmoney.com. I would go on it on a daily basis. You can see all the revenues being generated on chain on Ethereum. And then you can run your own PE multiple DCF model, and they do that themselves there. Like everything is open source. So it's a beautiful model. And I think, look, I think it's important. It goes back to if you and I started a company, how do we design our token model? This is where like it's incredibly important to have great investors around the table who can guide you to make sure you create the right decentralized model. Tokens have value in them. They're not just tokens for the sake of tokens. And so something like Ethereum is one of the best business models. And I want to talk about a few other models on the consumer side that are maybe easier to understand
Sure.
that are designed that way. One maybe I'll talk about is Demo.
Right.
So the issue in car data generally, I'm sure you've gone to the DMV before, and your car data, insurance, everything related to your car is completely distributed in many different places. There's no single place. It's poorly distributed across automakers, insurance companies, DMV, public records. There is no one place that has an open source available data for your car. Demo is both a software and a hardware blockchain company that connects your car on a decentralized Demo platform. It's an open source blockchain. Why in the world would I want to connect my car data and share it on an open blockchain? Well, it goes back to, if you do so, you'll earn Demo tokens. Customer acquisition 101 in blockchain. The way instead of spending money on ads on Facebook and Google, I incentivize users to become actual owners of the network by using the product. Demo has now signed up over 100,000 users to connect their cars. And they're early in their progress. They want to get to 1 million plus in the next 12 months. Now, where's the value in that business? Sure, I connected my car. So you bootstrap the network because Manny and Aram just joined and they connected their car. They're earning Demo tokens. They can see their car data on the platform. But the actual business model of Demo is to transact and create a platform where if you need to maintain your car, refinance your car, change your tire, do anything car related, you can do that on the Demo platform. And as revenues are generated on that platform, they're used to buy back Demo tokens. So now again, Manny and Aram are holding Demo tokens. They're incentivized to share their data. They transact on the platform with any third-party provider. Demo's business model uses to give value back to the Demo tokens. So it goes back to, I as a user shared my data, but I got compensated for it and it's transparent. Doesn't exist today in traditional Web 2. They have, I mean, near-term goal is 1 million cars, 60 billion in value by the end of next year. Value meaning transaction value, like actual GMV. It is an amazing way for customers to control the data, get compensated for it, and it's open and composable. Demo can shut down its open source platform to, oh, this insurance company can use it, but you can't because I don't like you. They can't. It's open source. And so Demo is a great example of a company where data is open, customers are getting comped for sharing their data, and the tokens have value in them because the revenues that are generated on the platform directly link to the token value.
Yep. Buy it back, raise the price. That makes
Yep.
a lot of sense. So
Going back to literally the first thing I said, value and ownership being programmed into the blockchain. That's the novel concept that has happened over the past 6 years. It's not the database that sits at the bottom of it. It's that an application has decided the value and ownership should not be given to Facebook or Google only. It should be given to the community.
Right. Yep. Completely decentralized. That's amazing. So we're running close up against the clock, and I do want to give the audience a chance to ask a few questions for you, Aram. But you're very passionate about the space. As you mentioned, you're in it every single day. What emerging trends in blockchain and crypto are you most excited about to come?
So I'm going to sound hypey and cliche, but I do think there's some interesting things, small percentage, but interesting things happening at the intersection of AI and blockchain. So where is that interesting intersection? It's a small subset of all the hype, but I think at the input stage of AI, and I'll explain what that is, blockchain can be hugely pivotal. So right now, AI as a technology has really two issues early on. It has issues with hardware provisioning, which means that they need GPUs and application-specific integrated circuits to train their models. That hardware is controlled by a few large cloud service providers, NVIDIA, Google Cloud, Azure, IBM, etc. Blockchain can play a fairly big role in the allocation of that computing power by a decentralized business model. So if you and I have unused GPU capacity, we can put it on a network. There are a number of companies. One of them is a company called Jensen, Gensyn. We can put it on the Jensen network. And now it's an open source blockchain for anyone to use to train their AI models. We're not reliant on the top 5 firms anymore. So in a sense, you created a decentralized protocol to incentivize and coordinate cost-efficient access to train your AI models. So that's the number one. GPU hardware provisioning on the blockchain is a really interesting concept. Secondly is training your data. For AI to be actually effective, you need to continue to train your data. What does training mean? Well, you have to label it. You have to say, okay, this cat is actually a cat, this dog is actually a dog. And you need to do that millions and millions of times. Today, that's really done by the large tech companies and the internal teams within these large tech companies, Facebook, Stripe, etc. Similar to what I said about GPU provisioning on the blockchain, that data effort can be done through decentralized networks, where you reward participants on an open source blockchain via token rewards, who can then train those AI models. We have companies like Giza, Giza, that are doing that. So at the infrastructure input stage of AI, I think blockchain can play a huge role and demonopolize what's happening. Again, it's the same thing you've seen in Web2 consumer application. You're seeing like 5 or 6 large companies eat the share of AI. You can actually decentralize that through blockchain.
That's fantastic. All right, if anyone has any questions for Aram, please drop them into the chat and I will do my best to address all of them.
I didn't know there was a chat here. Interesting. Can I see the chat too, or?
I don't know, I think it's only on my end.
Okay. Maybe I confused everyone at this point.
No, it was very well articulated. Okay, so here's one. So, you mentioned 2018 and the subsequent years to in the crypto space. There was obviously a lot of volatility that took place. I think Bitcoin was down 80%, took an 80% drawdown at one point. Do you think that the worst is behind us in terms of volatility? And as a secondary question, do you expect another FTX or another shoe to drop in the industry?
Let me take the second one first. The answer is I don't know. There are a number of companies out there that are large that we have no exposure to, but I would put in the suspect category. Not as bad as FTX, but if they one day collapse, I wouldn't be surprised.
Mm-hmm.
I think there are a lot of the cleanup has already happened in the industry, but I would not be surprised if that happens again, like maybe not to the FTX scale, but you will always have bad behavior, whether it's traditional venture, whether it's blockchain. I think FTX rose with the bull market, and I mean, if I tell you the fundraising stories for FTX are remarkable, like people would commit with like no work at all being done, zero work. And so like, it was literally like, are you in or are you out? We're closing in the next day. Like that was the diligence process. It's even like there was Theranos type like diligence. This is like maybe even worse than that. So I don't suspect anything of that scale will happen, but there are always some projects that we're skeptical of, like, what are they doing? There's no transparency into their balance sheet. They're not putting their data on chain. So yes, could there be more blowups? At that scale, probably not. human behavior doesn't change, unfortunately. Like, let's just take traditional tech. You had the dot-com, you had '08, you saw what happened with COVID with prices. I mean, look at late stage traditional venture. The companies were raising at 30 to 100 times ARR. Like, that's just public markets for the rule of 40 plus companies are trading at 8 to 12 times max. This is the highest quality software companies. Tiger Global did over 300 deals in 1 year. I mean, it's literally a deal a day. Like, and by the way, so what happened to blockchain didn't just happen in blockchain, it happened in traditional venture. The problem with blockchain is that it's liquid. So you feel the pain immediately. I will tell you, there are hundreds of unicorn private companies in traditional venture right now. They're worth a very small fraction of the last valuation they raised at, but they're still kind of sitting at that valuation. And they're not raising another round. They keep doing riffs to always have a runway. That doesn't mean they're worth anything close to the last valuation. Now, in blockchain, as I said, on-chain data, immediately feeling the pain, especially as macro environment gets worse, yeah, you're going to be down 30 to 50%, but you have transparency. We have looked at late stage 2021 vintage portfolios that are sitting around 1x. They're probably worth 0.1, 0.2x. If you can get your money back in 10 to 15 years, that will be a heroic outcome. Which one do I prefer more? Transparency and feeling the pain quickly versus that masked performance. I would take transparency every day. So cycles will continue. I don't think that's going to change. Like, human behavior will continue. Like, when the Bitcoin ETF was approved, some of these dog coins came back, meme coins came back. I don't know if you guys saw, but there was a dog coin. The community, this is the best part of being decentralized community, like, they came to a decision to spend 650,000 to do an ad on the Sphere in Vegas for that coin. And after that, the coin was up, I don't know how much. I mean, look at GameStop. Like, this is not different. Like, the human behavior continues. And I think it will continue. We'll have more cycles in blockchain. The way we have always thought about it, take a fundamental approach, invest in exactly what you understand at the earliest stages. We talked about Uniswap. Uniswap is multi-billion-dollar company. Our manager invested at a sub $100 million valuation. Sure, it went from 8 billion to 6 billion in public markets. Our manager made an immense 60x their cost at the very least. So we care about being early in the most fundamental projects with our managers. There is going to be many cycles in blockchain and venture. I think people will tell you we're probably going into a bull market. ETFs are being approved. The election season is coming. Fed will ease rates. I can see that. I can also see that crashing very quickly in 2025. And so what's important for us is when 22 happened, we slowed down investing. Like, when you look at our capital put to work in the bull market, it was very low compared to the bear market. We're not going to get everything right, but we slowed down our pace and we missed all the blowups.
That's great. Okay, we have a ledger security question here. So, would you leave BTC on Coinbase or move it off the platform to either a digital wallet or a drive like Nano Ledger?
So I have a Nano Ledger from years and years ago. Like, it is a pain to use it. Like, you have to just like keep clicking to get the passcode. Coinbase is an incredible company. Like, their security to custody is cold storage sharded over many segments. Like, I would not hesitate to use Coinbase. Easy to use, incredible company, great management team, regulatory compliant, continues to innovate itself. Coinbase has come up with a wallet that you can use as well. So, like, you can do everything on Coinbase. Soon you will be able to keep your demo tokens on a Coinbase wallet and keep your Bitcoin on a Coinbase wallet or exchange as well. So I would not shy away from using Coinbase. Everything else is going to be painful from a user experience. To give you a sense, we at Accolade, for our funds, we use Coinbase as our custodian.
Excellent. Well, I think that takes us through our questions. We're up against the clock. So thank you everyone who joined us today. Aram, thank you for all the information. It's a pleasure to have this webinar with you and gain so much industry knowledge, and hopefully we'll do another one of these again in the future. If anyone has any follow-up questions for Aram, please feel free to send them directly to 12 Points. We're happy to share them with Aram and hopefully get you an answer as quick as possible.
Yeah, happy to do a follow-up, answer any other questions. Really enjoyed the discussion. Hopefully you can tell we're incredibly passionate about the space, and inning 1 or 2, we have years and years to go to build the space.
Yeah, well, we're just happy that we've got someone like you on our side to help us sort through these things.
You guys have been great partners. We're really excited.
All right. Well, thank you, Aram. Have a great day. Everyone who joined us today, thank you for the time. You will get a copy of the recording, and if anyone wants another copy of it, please reach out.
Thank you, everyone.
Take care.